Hello and welcome to this video tutorial which follows on from the CANEGROWERS Part 1 budgeting tutorial. This is Part 2 in which we will review the outputs of the CANEGROWERS Budget Tool. In the previous tutorial, we had completed entry of our data into Sheet 2 Budget Data Input. We looked at the supporting calculator sheets which helped estimate the costs of some of the key inputs. For this tutorial, we start from the point where we have completed all of the necessary data input. Our focus will now move to the interpretation of results. The first results page begins with Sheet 5, the CANE Budget Summary. This sheet provides a summary of the cane production enterprise income and costs in terms of dollars per ton of cane, dollars per hectare of cane, and total dollars for the farm enterprise. In doing so, this allows you to assess the cost for each input against strategies such as targeted cost per ton and other norms or benchmarks. The subtotals at each level provides a sense of the cost structure of the overall operation. Different margins can be useful for answering a range of questions, such as how my cane enterprise margin compares with my soybean margin, or what is the enterprise performance before financing and return? Let us now take a look at the worksheet layout. We'll start at the top section first. The first table at the top provides the pricing and CCS assumptions, along with the physical parameters, including area and yield, which you entered in the Worksheet 2 Budget Data Input. The main table provides the cane budget breakdown. The income or revenue row in dark green shading is calculated from the CCS, sugar price, and constant to give the income per ton and per hectare, as well as for the farm, or more specifically the cane enterprise. Thereafter, the direct or variable costs are listed. The peach shading indicates the basis on which the costs will vary. For example, harvesting costs and levies are typically charged on a dollar per ton basis. Hence, if the tonnage changes, such as yield up or down, or an increase in area harvested, then the total cost will vary. Other costs are typically varying on a cost per hectare basis. As more or less area is operated, the total costs will rise or fall by the per hectare rate. Fertilizer is a good example. As more area is returned and planted, the amount and therefore the total cost of fertilizer increases. Similarly, for fuel and oil, as more area is worked, there are more machinery hours for traversing the land, and hence the quantity used and cost will change accordingly. This is not always perfect, since there are, at times, perhaps some overhead portion included, but generally it should be sufficiently accurate for budgeting purposes. Remember, a budget is not a perfect science, as we are dealing with the future. Sometimes near enough is the best we are going to do. The bottom line in this section is the gross margin, which is the gross income less the directly attributable variable costs of growing the crop. The gross margin is really important in providing a basis for comparison between crop enterprises to indicate their relative profitability. For example, how does the cane gross margin compare to, say, soy or corn? Bear in mind, there may also be capital inputs to consider, which are not in the gross margin. Productivity and prices for each crop will vary within and between seasons, which can significantly affect gross margins. So, in making decisions on crop mixes, it is advisable to undertake a sensitivity analysis and to get a sense of the relative profitability under different scenarios. The other good thing about the gross margin is that it is comparable to any other cane farm. This will enable you to benchmark your farm against other farms, maybe a group of your neighbors, and look for the reasons you may be different. For example, if your gross margin is lower than the benchmark, it may reveal that your yield is the same as the benchmark, but your costs are higher, and you can start to investigate why. We can discuss this further at the workshop. Now, moving down the table. Here we can see the fixed costs that we have captured in Worksheet 2, Budget Data Input. Notice that the peach coloring is now in the dollar per farm column. These are the farm overheads and will generally, in the short term or a production season, not vary if you have a good crop or a bad crop, or you grow a break crop, or you don't grow a break crop. There might be cost increases or decreases here from time to time, but these are independent from the cropping activities. After deducting the fixed costs from the gross margin, you are left with the farming margin after cash costs. This provides a good indicator of the farm's potential before the financing costs, depreciation, and drawings. This farming margin can be used to compare to other cane farms, but it is not useful to compare other crops on your farm. It can also be used as a measure of the income available for you to plan the balance between paying interest, replacing equipment, and paying yourself. So if you are buying a farm or paying out your parents, this farming margin is critical to establishing the debt level you can afford, or if you are having a discussion on succession planning, this will be the amount available to pay interest on borrowings, replace equipment, and pay mum, dad, and or siblings and yourself. The overall net margin is the bottom line for profitability. This is essentially the return or growth value for the business apportioned to the cane farming enterprise. This is not comparable to other farms, as each farm has different levels of debt, depreciation, and drawings. If we look back one line, here we can find the total cost. This is the total cost of production given the inputs we have used. If revenue matched the total cost, then the enterprise would break even and there would be zero net margin. In this example, income was higher than total cost, so there is a positive margin of $47,375 in the net margin line below. The total cost in our example is $479,670. At this total cost point, all production, financing, and living expenses are met within this value. It does not, however, include any capital purchases or repayments, nor any tax payments. To break even on this cost, in other words, income matched this cost, there would be no surplus return on equity. So ideally, we want to achieve more than break even, though this may not always be possible for every season. The break-even sugar equivalent is indicated to the right of the table. This is the theoretical value for the price of your GEI sugar that would, under the current set of production assumptions, set the total revenue to match the total cost. This provides a floor target for your sugar pricing. You would want to achieve an average price for your sugar that exceeds this target. If that is not possible in a particular season, then it would be important to carefully review the business's financial situation and plan actions for minimizing losses. There are two break-even prices shown. This relates to which price you are comparing with. The break-even price when looking at pricing pools, which are quoted in tons RPS, is in the left column, while the equivalent price to compare against forward prices at dollars per ton actual is indicated in the right column, because published forward contract prices are not usually converted to RPS ton adjusted values. In both instances, the shared pool value should be deducted to get the true break-even value. In years that the shared pool value is a cost, then that value should be added, and vice versa if it is a surplus. For example, if the current season shared pool price is $10 positive, then your target for breaking even on pool pricing would be $443, or $10 lower than the $453 shown. Also on Worksheet 5 are some additional indicators that provide a bit more depth to the cost and net margin results. The first table indicates the break-even cost at each of the subtotal levels in the cost structure buildup and shows the cane yield and tonnage at the given sugar price that is required for the cost totals indicated. This provides a sensitivity range for yield and can answer the question, if my yield is, for example, 80 tonnes per hectare, what level of cost will this cover? In this case, it would cover all of my finance costs, fixed and growing costs. But it is slightly less than total costs, so some of my depreciation and/or owner's cost would not be covered. The second table shows what happens to the net margin per hectare if CCS and/or cane yield changes. Recall that net margin is the bottom line from our budget. This number here of $324 per hectare is the margin that we have calculated in our budget. This is the net margin, given all of our cost assumptions, and also given the expected GEI sugar pricing to be achieved. So that is the number in the middle of this table, aligned with our baseline estimate of CCS and yield, and as mentioned, all cost assumptions. In this table, we focus on testing changes in CCS and cane yield to see what happens to our baseline margin. If cane yield is reduced by 5 tonnes from 90 to 85 tonnes per hectare, the net margin is reduced from $324 to $172 per hectare. If at the same time CCS increases by 0.2 units from 12.8 to 13 CCS, the net margin then moves from $172 to $248 per hectare. The pie chart on the right provides the proportional cost breakdown of all input cost elements and illustrates graphically the contribution of each item to the total cost. We will now move on to worksheet 6, which provides further details on the break-even sugar price. The first part of the table summarizes the cost build-up with subtotals for growing costs associated with the gross margin, then adding fixed costs, followed by the addition of financing costs, and finally depreciation and owner's costs to reach total costs. At each level, the equivalent break-even sugar price is provided. To explain the break-even sugar price, let's look at growing costs. The break-even price for growing costs is $338 per tonne IPS sugar. This means that if a pool price of only $338 is achieved for the season, then that will only cover the direct growing costs, also known as variable costs. At the next level, $378 would cover only the direct fixed costs and growing costs. And so on until we reach $453 as the break-even pool priced sugar to cover all costs. At $453, there would be zero profit for this business. Similarly, this information is also provided for forward priced sugar. The sensitivity table is similar to the table on worksheet 5, but instead of margin, this table shows the break-even sugar price required for different variations of CCS and cane yield. So in our example, the break-even IPS or pool sugar price is shown as $453 per tonne for our baseline estimate at 12.8 units CCS and 90 tonnes cane per hectare. Using the table, we can see that if there is a reduced yield, say down to 85 tonnes per hectare, then there is a need for a higher break-even sugar price of $473 per tonne to make up the difference. Likewise, if there was to be a lower CCS outcome than expected, in this example from 12.8 down to 12.6, then there is again a higher break-even sugar price of $484 to make up the shortfall. $484 break-even is the combined impact of lower yield and lower CCS in this case. If it were only the CCS that changed, then the movement would be horizontal in the table row. Also on worksheet 6 is a table which shows the sensitivity of the break-even sugar price to changes in total cost of production per tonne of cane. In this case, our starting point in the middle row is the cost of production determined in our budget. This is shown in dollars per ton of cane. Recall this number comes from the total cost line in the budget summary, here, which is $36.50. The break-even sugar price, as you've seen at this cost, is $453 per ton sugar. The table and corresponding chart shows what happens to the break-even price if total cost were to increase or decrease. Another feature on this worksheet is an option to toggle between IPS and actual prices, which will display the sensitivity table in terms of either price. In other words, the pool price or futures prices as the basis. Here you can see the same tables with the actual sugar price displayed along with a note showing that this is for forward pricing comparisons in this case. Moving on to worksheet 7, which is where you can input your sugar prices and pool allocations. We have discussed this in the previous video, so I will just reiterate what is needed here. The important thing to remember is that if you are using the calculated option on worksheet 2, then you will need to ensure you add your expected prices for each pool you will be targeting in the budget season column. In doing so, this will calculate a weighted average here that will provide the sugar price to the model for the income calculation to predict the revenue and cane net margin. The next feature to discuss is the ability to conduct some what-if analysis. Of course, a budget is only an estimate or forecast of a future outcome. There will be a variance between what is budgeted and the final outcome. So it is always good to conduct some what-if analysis to test the impact of outcomes that may be different to what we've estimated. This helps to objectively assess the impact of risks on the economic bottom line for the cane business. Moving to worksheet 8, we will look at how to conduct a what-if analysis. The sheet follows the structure of the cane budget summary, but includes a few additional columns. You can see here that there are blue shaded cells which require user input. This is where you would enter any changes to the base case for which you'd like to test the impact. It can also be used as a side-by-side comparison against a benchmark, for example, compared to last year's actuals. Note that this does not alter your baseline budget workings at all, and only provides this comparison on the current sheet, worksheet 8. Let's start at the top of the table. Here you can now see more clearly the inputs required. The first step is to set the benchmark or change case figures in the blue cells to match the base case so that there is no difference. Then you'll adjust those that you would like to test the impact for. In this example, we have changed 2 items in the productivity part of the table. I'm testing the impact of a drop of 0.2 units of CCS and at the same time a yield increase of 10% as a what-if scenario for a much better growing season than initially anticipated. Lower down in the table, we also need to set up the costs. Here we also need to copy from the base scenario to the what-if cells that are blue shaded. These should be taken from the corresponding columns because the basis for change of those costs are either in dollars per ton, dollars per hectare, or the cost for the whole enterprise. Once this is set up, you can then make the desired changes and review the outcome. In this example, there are 2 aspects that we should consider. Firstly, because we changed the yield at the top of the table, there is a difference indicated in the difference column. Note, however, that we have not made any changes to the cost per ton. The second is an example of changing the cost, which creates a cost difference. Here we have increased the cost of fertilizer and chemicals. This cost per hectare change could be due to an expected change in price or in quantity that is used per hectare of the inputs required. The what-if comparison can also be used as a benchmark comparison. You can input the benchmark into the blue cells and compare the outcomes. For example, you could input last year's financial outcome to compare with the current year budget and consider whether the differences make sense. thus helping to ensure budget accuracy. Or you could use it to compare against other norms. For example, the same budget using the mill average CCS against your CCS, and or district average yield versus your yield. If you capture the details of business loans, then the impact of changed interest rates can be assessed here too. The what-if part of the tool is also very useful to assess the impact of a particular risk. For example, what will be my net margin if my yield decreases by 20 tonnes per hectare as the result of a cyclone event? Will it be a shortfall, and by how much? In this way, we can test the magnitude of how certain risky events could impact the annual budget and or cash flow using the budget tool, which can then help inform your risk mitigation strategies. Moving on to the next results sheet now. We have worksheet 9, which is the business budget summary. This view pulls together the costs from any other enterprise that you have entered for the farm. It provides a summary view of the whole business with a side-by-side summary of each enterprise and how those contribute to the overall business. At the gross margin level, enterprises can be compared in terms of profitability, which can be useful. However, decisions on enterprise mixes should be made based on longer-term outcomes, as enterprise mix usually considers the risk-reward combinations of enterprises and how those risk-reward outcomes play out over a longer period. Another aspect to reflect on in the summary is whether the fixed cost allocations to each enterprise make sense. Are these borne by each in a responsible manner? For example, if you have a mix of crops and you allocate costs disproportionately to the cane enterprise, that may result in an unreasonably high sugar price target, which might not be achievable in the market. Or the opposite case too. We now move on to the additional reports available in the tool. The remaining sheets cover the balance sheet, a monthly cash flow, and some ready reckoners. The balance sheet provides a snapshot of the financial health of a business at a given moment in time. It lists all of your business's assets and liabilities. This information can be used to determine your net asset value at a given point in time. That is, if you take the value of what you own, assets, and deduct what you owe, liabilities, what you are left with is your equity in the business or your net assets. There are a few more levels of detail beyond total assets and liabilities. These can be subcategorized into current assets and current liabilities, which provides further insight into the farm's financial health. Current assets are typically any asset that will likely be converted to cash within a year, and current liabilities are those that are paid back within a year. Whereas non-current assets are typically longer-term investments, such as land and equipment. Non-current liabilities are long-term debt obligations. A balance sheet prepared by an accountant will ensure asset valuations are in accordance with generally accepted principles and be compliant for reporting. In the budget tool, there is scope to capture values for a high-level example balance sheet. This allows you to consider risk associated with financing the business. Financial ratios are typically used by accountants and economists to assess the balance sheet as well as the income statement. These ratios do not provide answers as to why a business is doing well or poorly. Rather, financial ratios help in pointing out areas to examine and in asking the right questions about the business. There are three types of ratios derived from the balance sheet: solvency, liquidity, and profitability. Solvency ratios show the ability to pay off debts. Liquidity ratios shows the ability to turn assets into cash quickly and meet immediate cash flow requirements. And profitability ratios show the ability to generate income and profit. This ratio requires information from both the income statement and the balance sheet. To interpret ratios, accounting guidelines and benchmarks can be useful. These can be ratio results for similar farms in the district and comparing with the farm's own historical results. The context of the results should also be considered. For example, has the farm recently undergone a significant expansion? or recovering from a disaster situation. Obviously, these events will affect ratios. So, back to the budget tool. We are now looking at sheet 10, which contains the example balance sheet. In this example, we have populated a balance sheet. We can consider some high-level questions given this information. The first is, are we solvent? That is, are our total assets greater than our total liabilities? Solvency analysis also considers how much of the business is owned by the farmer and how much is owned by the banks. Solvency is measured by debt to asset ratio, equity to asset ratio, and debt to equity ratio. All three ratios are mathematically related and provide similar insight but add dimension to the measure. This is important because if our liabilities are more than our assets, we won't be in business and we would need additional equity invested into the business to continue to operate. Within the balance sheet prepared by your accountant, we can also use the subcategories to consider the business liquidity and whether we have enough cash to meet the business needs. This is achieved by comparing the ratio of current assets to current liabilities. The current ratio, as it's known, provides an indicator of whether the business has enough cash to meet debt obligations that are due within the operating year. The monthly cash flow budget is also an important part in assessing liquidity. Profitability measures the amount of profit a farm generates through its operations. The ratio of the farming margin to assets or equity shows how well the farm uses them to generate revenues and create a profit from those revenues. It should be kept in mind that return on assets is low for a farm business when compared to other investments, as it does not include land appreciation in the calculation. Given that a large percentage of farm returns are in increasing land values, ROA or return on assets will naturally be low. This does not mean that farms are a bad investment, just that the ratio does not recognize this appreciation. We should consider our ratio results from the perspective of those who are financing the business. If our liquidity ratio indicates that we will be short of working capital, for example, a current ratio that is below 2 or 1.5, then we might be approaching our banker with a monthly cash flow projection to seek facilities that will cover the periods of limited cash. It would also be important to consider your solvency ratio when engaging with financiers, as this forms part of their assessment of the risk of lending to your business. For example, a rule of thumb is that a debt to asset ratio of below 0.3 is considered low risk. Next up is worksheet 11, which considers a monthly cash flow. This is useful should you need to forecast your monthly cash flow. The monthly cash flow can identify any period of low cash availability that may not be apparent in the annual view. There are a few aspects which you will need to consider. Firstly, cane payments for estimating monthly revenue. Here you will need to understand the harvesting schedule so that the correct expected tonnages can be allocated to each month. You will also need to know what the pay schedule is that has been arranged through your marketer for advance payments, including provisional prices. Next, you will need to consider the expected timing of all your payments. Also keep in mind whether any of these will be flexible and might be able to be delayed in the case of any cash shortages. Also impacting cash flow will be tax and GST payments per the timing of business activity statements. So this will also need to be considered. The result will be an indication of where you may have a potential cash flow deficit for which you could plan on accessing other cash-based assets or approach a financier for overdraft facilities. On the other hand, periods with significant positive balances could indicate an opportunity for a short-term investment. Finally, the tool includes some ready reckoners on sheet 12. These provide some simple-to-use calculators to gain high-level insight into the relationship between sugar prices and production costs, and the influence of CCS and exchange rates. The first calculator provides the equivalent sugar price at combinations of CCS and production costs per tonne of cane. You can input your assumptions, which will set the middle value. You will then be able to see what happens to the equivalent sugar price should the assumed parameters change. For example, if production costs per ton of cane rose from $35 to $37 per ton cane, then the equivalent sugar price rises from $424 to $449 per ton sugar. If at the same time the CCS were to be better than expected, with a move from 13 units to 13.5 units, here we can see the equivalent sugar price decreases from $449 to $425 per ton sugar. This will help get a feel for what sugar price to target to cover a range of risk possibilities. The next Ready Reckoner takes the reverse approach, and you can enter in the expected CCS units and the price per ton of sugar. The calculator provides the total cost per ton of cane equivalent. You can see what happens to the cost per ton of cane equivalent should the CCS or sugar price change. For example, if the sugar price increases from $500 to $520 per ton of sugar, while CCS reduces from 13 to 12.75 units, the equivalent cost per ton of cane changes from $41.10 to $41.55. The final reckoner converts the international sugar price from the basis of US cents per pound to Aussie dollars per ton. You can input the central parameters to provide the equivalent value. And once again, you can see the impact of any changes in either the sugar price or exchange rate on the resulting sugar price in Aussie dollars per ton. For example, a reduction in the US cents per pound price from 18 to 17 cents per pound, and an increase in the exchange rate from 70 to 72 Aussie cents per US dollar means that the equivalent sugar price changes from $567 to $521 per ton of sugar. So these reckoners can give you a good feel for the impact from variations in any of these parameters and what that means for your sugar price as well as relating to your cost of production. This brings us to the end of the video tutorials on the CANEGROWERS Budget Tool. The next video will delve into the sugar market and provide you with some strategies to cut through the noise of the world sugar market to support your pricing decisions.